I kind of noted the ocean of capital that was available in this space in years past has kind of dried up. Can't throw a rock anymore and hit four buyers, but there are certainly pockets out there where if you know people's strategy and where they raise their capital, there's like a smaller market of buyers, but those buyers actually align with opportunities a lot better.
When we have conversations with sellers, the sellers are focused on market value and the buyers are focused on cap rate. Cap rate pricing's coming in typically at the highest, like 10 to 15% discount. A 10% discount is kind of like the threshold where a seller oftentimes is like, I'm not going to go below that.
The further back you go away from actual cash flow, the more the risk is to the buyer. Taking on development risk, taking on building risk, taking on lease-up risk, taking on a lot of market risk. I heard of the biggest firms in the market, it actually hired people to manage their bulk acquisition strategy. So I think bulk acquisitions might be making a return. I don't know how big or how fast and furiously, but
Hey everybody, my name is Ted Ferry. I'm here with Adam Stern on Ted and Adam Unleased on Everresi Media. No, we're here post IMN SFR West. I think we all had a great time out there. It's always great to see everybody run around the conference, give people high fives, talk about the industry, and of course, end it off with the Strata Party put on by Mr. Adam Stern. Thank you very much for hosting us again this year. It sounds like you might be a little sick from it.
Anytime said. I had my traditional come home and get sick this weekend. So I don't know if this happens to anyone else out there, but I work from my house and I'm around people very seldomly when I'm at home, other than just meetings. So my immune system basically says, "Hey, what are you doing with these dozens of handshakes? I think we need to kick up the white cell blood count and make you sick for a few days to make you realize how lucky you are to be healthy most of the year." I just came out of that over the last couple of days. It seems like a lot of people get sick when they come home from big conferences. I'm no exception. But
don't listen to what anybody says. You look great today.
Well, thanks, man. So, question for you: there's usually a vibe at these conferences. Over the last several SFR conferences, the vibe was very subdued. The crowd was a little bit smaller, and the vibe was a little bit down. What was your take on the overall tone of this conference as opposed to last conference or a couple conferences ago?
Yeah, I think honestly a lot of the same. I think maybe status quo. I think we're working through some of the things that have been happening in the industry as we've kind of chatted, here and there. I think we're moving out of a time where maybe retail sales were kind of the number one place to go to sell your portfolio.
Yeah, I agree.
We might be at an inflection point with that. And I'll say the height of optimism that I walked away with was on the opening panel and talk about the pace of new BTR deliveries starting to decline going into 2026. There's some kind of optimistic outlook in the second half of 2026 that some of the Florida, Texas stuff where we it's longer lease times and more active listings on the market, that should start to wane a bit and kind of get back to normal.
Yep. It's funny. The retail market was like the hottest place to dispose of assets. And it was kind of hard, like being an SFR portfolio brokerage when that was such a strong draw. When that was, before that, like selling retail and selling as either single site build for rent or SFR portfolios, either was a pretty easy option because there was so much capital out there. There's so many buyers buying with both hands. What I came away this conference with is the retail market it's flattened out a bit. It's not so much it's still attractive or the most attractive option if you can basically use it to get property sold. But there's kind of a view of owners across the board that have these, portfolios, whether they're built for rent or SFR, realizing that, retail isn't the most efficient option in terms of price or timing today. Could be pretty hard and less efficient to sell retail. So a lot of them are coming back to us and asking, are there buyers out there for my portfolio? And what I kind of noted was, the ocean of capital that was available in this space in years past has kind of dried up, and it's still there, but it's not.
That cap rate buyer, like the cap rate pricing, it kind of vanished from the market for a long time.
Yeah, but it's not gone. It's like it dropped into 1,000 little lakes, right? So it's not easy to throw it. You can't throw a rock anymore and hit 4 buyers for, an SFR portfolio or build for rent. But there are certainly pockets out there where if you know people's strategy and you know where they raise their capital and what they raised it for, there's like a smaller market of buyers, but those buyers actually align with opportunities a lot better if you know where to look. So
Right. So I'm just curious because I mean, in our buying and our pricing, I know how we look at it, but with those pockets of buyers, how do you think that they view their pricing in a, cap rate versus market value? Is it one or the other, or is it a combination of both, or
yeah,
or
yeah.
either?
It's an interesting question. I know the way that they look at pricing is they look at what they think market value is. They could pull comps and try to understand retail value. But even today, like with property sitting on the market for longer, it's harder to get a conservative viewing firm to actually place a value in today's dollars. So like there's market value, but there's also the cap rate that they need to hit, and that causes a differential between market pricing and what they'll actually offer. Um, and kind of the third leg of the stool is looking at pricing that a retail buyer would have to pay in order to own the home and what their monthly mortgage payment, taxes, insurance should be. And they're all underwriting their rents to some kind of deficit to that number. They need to be sure that whatever the rent rate is, it's at max what a retail buyer would pay. Preferably, it's some margin below what the monthly payment of a retail buyer would be. So, like when we underwrite properties, for a fund buyer, we got to look at, all right, what market price is, what kind of cap rate the buyer wants to buy at, what the differential is between those two numbers, and then making sure we're underwriting rents at a number that's at some kind of discount to what a retail buyer would essentially pay
Was still
for the monthly
there's
payment.
still a gap. There's still a gap, right?
Yeah.
Right. I mean, like, because sellers, when we have conversations with sellers, and obviously I'm not a broker, so we're buyers just trying to find stuff to buy, and it seems like many times the sellers are focused on market value and the buyers are focused on cap rate.
Yeah.
But there's probably some constraint of not paying over market value or not paying some percent over. But it's like if a seller very quickly can look like a Zestimate or a Redfin value to get their value.
Yep.
And they might be, if they almost never talk about cap rate. But it seems like cap rate pricing's coming in typically like at the highest, like 10 to 15% discount. And once it seems like a 10% discount is kind of like the threshold where a seller oftentimes is.
Yeah. It's not,
I'm not going to go below that.
it's like the lowest part. It's like it's the bare minimum that a buyer needs to feel like they have a good deal. Mind you, cap rate is just a term that we use kind of in the buying and selling community as shorthand for like a seller to show them or to put some reasoning behind pricing. There's a lot of logic behind the buyer setting a cap rate. They have all their metrics of what their cash on cash return needs to be, what their overall internal rate of return needs to be. Try explaining to a broker how to figure all those things out. You'll have a very, very tough time. But putting a single number on like a cap rate, that's easy to calculate. NOI divided by purchase price, that's a simple number. And for a broker or anyone looking to essentially transact in real estate, that's a really easy metric to understand. So like, I don't use cap rate. I use cap rate to explain what buyers need in terms of pricing. I don't think sellers generally understand why cap rates are the way they are.
What do you think? I mean, so cap rate, it's kind of interesting. I've heard people talk about cap rate more at this conference than any other ones, and actually ask specific questions about it. It kind of seems like there's, that we might be in another discovery period, right? Like we're that, kind of moving away from the retail exit being maybe the highest value or consistently the highest value or far outperforming. But I was on a panel, got a specific question about somebody asking for a cap rate, like, hey, what would the cap rate be from the sale of my portfolio right now? Yeah, another group where the whole topic was about that.
Yeah.
What do you feel like the appropriate way to look, maybe both from a buyer's perspective and a seller's perspective? What do you feel the appropriate numbers to place on cap rate are for the market today?
Yeah, it's a tough question. I think it's dependent on the market, number one. I think it's dependent on the asset type that you're trying to transact on, number two. Type of asset, is an A-class location, B-class location, C-class location. And what the actual strategy is. Is it a buy, rehab, and hold? Is it a buy and do nothing and hold, or is it a flip? It's I think the right way for any buyer to kind of estimate whether or not they're off on their cap rate target is just understanding the seller psychology. Like, they all know what their properties are worth. Like, Zillow is an easy way to get it. A lot of people don't trust Zillow, but you can go and buy data from any data provider and get a pretty accurate AVM, automated valuation model, telling you what a property is worth. That's what's unique about SFR as opposed to commercial. The only way to evaluate commercial real estate is based on cap rate. That's what sets the value. SFR has a totally independent valuation model of being comparable to other properties because it's SFR. So the way I think buyers should look at it is figure out what the cap rate is at market value. Figure out what cap rates are at market value using the current rents of the property, and then take into account what it would cost a seller to essentially sell it at retail pricing.
Right.
And it's a number of different ways to do that. Some sellers have properties in worse condition than others. Some of them had deferred maintenance. So there's a whole spend component to this that a seller has to go through in order to reach maximize resale value. I always just kind of tend to think in a market, if you look at what the actual value is versus the current in-place rents, and you work off of a 15% delta, it's probably right around where you need to be in terms of a cap rate.
But like numbers, actual numbers, like that was great color, but like actual numbers where, broker talking to broker, hey, where do I need to be to transact? It's kind of like mid to high fives right now, maybe like a 5.25 to 5.
What are you talking about? Are you talking about like, downtown?
I'm talking about middle of the fairway, institutional markets, scattered site acquisitions.
It's easy, right? Like literally, I go over this with most of my builder sellers every single week. And right now, if I'm getting something that is a to-be built home via forward contract, I think we need to be like at a 6.25, a 6.25 cap rate. That means the buyer's taking on lease-up risk. It's not for sure. So whatever we're underwriting in terms of market rents, there's some delta there about where the buyers are going to underwrite. So like a 6.25, we underwrite there. The buyers might look at it more like a 5.75 or a 6. So like forward contracts, 6.25, properties that are delivered, properties that are already built and are ready to be delivered, meaning the lease-up risk is a little less murky because they're getting the units in the short term and they could be a little more sure about where rent rates are. I'd say like a 6 cap rate is essentially the deals that I'm pitching right now that are getting traction. Anywhere south of there aren't really being looked at seriously. And if you have a rented property with a tenant in place, I'd say a 5.75 for new construction, right? So like
that's an interesting perspective. So you're basically saying because of the lease-up risk that build to rent or new construction is pricing at a higher cap rate.
Yeah, the more risk the further back you go away from actual cash flow, the more the risk is to the buyer. And the earlier they're coming in, the higher cap rate they need. So like if I don't even underwrite land deals to cap rates anymore because it's like a fool's errand. I'll normally price those at a completely different metric. But like if a buyer's underwriting a build for rent at the dirt level, they're probably underwriting like, a 7 cap because they're taking on all this risk. They're taking on development risk, they're taking on building risk, they're taking on lease-up risk, they're taking on a lot of market risk. The further they get along,
there needs to be margin in there as well too. I mean, it might even be higher, right?
Yep. And again, cap rate being shorthand for brokers and buyers and sellers, that cap rate target that I put on there assumes there's a delta between everyone's underwriting, right? So like if I see a portfolio that's totally leased up and stabilized, and I underwrite it to a 5.75, someone else might underwrite to a 6, or the next person might underwrite to a 5.5. I just know if I get in the middle of that range, I'm probably pretty close to the center of the dartboard. I just need to show the seller that, hey, your properties are worth this. Here's the data that backs it up. Here's the pricing range you could usually expect from buyers buying at a 5.75 cap. That brings your pricing anywhere between a 10% discount and like a 15% discount. And if I have a seller that says, hey, I'll take between a 10 and a 15% discount, I'm a seller at that price, then it's cool. You're a seller. I'll work on your deal. If the seller says, no thanks, I need exactly market value to make this work, and I'm like, well, that's a 5.5 cap, and people might be underwriting that to a five cap or a 5.25. Then like, it's not worth my time. I just know that they're not sellers at that point.
So that dynamic where BTR or, new construction to be leased product that priced above cap rate right now, how does that compare? It's a little different than people are buying to in like April, May of 2022, right?
Oh yeah, ridiculously. Like,
I mean, it was flipped, right? People were buying, like placing a premium on the new construction at that point. And so even if it wasn't leased, right?
yeah, listen, I think they're still placing a premium on it because, they're new properties and they don't require as much CapEx, and they're probably going to be a little bit easier to rent. Cap rates have just changed dramatically over the last couple of years where, I've sold portfolios that were like built in the 80s back in 2020 to 2022, and they got priced at a 5.65 cap rate. That's where a new construction portfolio would be priced today. People just need a bigger discount to fair market value to buy these properties right now because I think they're underwriting less appreciation, less rent growth, maybe not higher expenses, but certainly like a more dimmed outlook on appreciation and rent growth than the years past. I know you're a buyer in this market. Like, are you underwriting vacancy and are you underwriting appreciation differently than you did, back in 22?
Your capital partners might be listening, so I got to be careful what I'm saying here, but
Tell the truth.
no, I think that like the vacancy metrics, things like that, lease up periods, they stayed pretty standard.
Yeah.
Maybe we probably adjust for those things at the property level where just maybe taking some off the rent. So because that's a tool you have to be able to try to lease things faster. So that's probably the number one change is that instead of maybe taking a more optimistic view on rent, versus market, and maybe kind of skewing slightly higher than a median market rent. Yeah, they're almost always taking the lower side, and just to try to create an easier activity for the leasing team in getting that property filled.
Yeah, yeah. It's just it's hard in this market to identify what we think things will rent at if they're vacant, and everyone's always going to err on the side of caution. And if we think it's going to rent for $2,300 wholesale across the board, buyers going to underwrite it at like $2,150 just to be cautious to make sure that they're not stuck in a bad spot. And
I mean, from a fixed dollar cost perspective, I mean that's definitely increased. I think the rule of thumb we used to have, even probably as recent as like 2021, is that maybe a turn, our target for a turn is like $1,500, and that's just not like that's nowhere near reality today. In most cases, I mean, I think you kind of have to parse out your, with your accounting, how much of your CapEx are you putting into your turn, but true turn costs, I think are, probably almost double that, more like 2,500, 3,000. Yeah. But you also have a much higher rent level as a basis too. So it's not, as a percentage basis, it's probably not that different.
Yep.
And I think that's a factor of just kind of global economy and, costs, construction costs and everything much higher today. So.
Yeah, I'm curious. Like, keep seeing these different options for buyers and sellers pop up to kind of solve problems. I think there's a big wave of inventory of people that are like, butting up against age 65 that have these big portfolios, and there's firms out there that are offering these solutions to do either 721 exchanges or exchanges into funds that have some kind of solution. Curious to know if you kind of identified any new players that had interesting models. I have a few, or I have a couple that I talked to, and I've actually done business with a couple. But I feel like there's a whole wave of people that are retiring that are looking for an exit right now, and because the easy times are behind us of selling portfolios or even single site build for rent, the opportunity for these firms to like have these newfangled kind of strategies, offering these newer solutions for retiring people that are looking to sell properties, eliminate property management responsibilities, defer taxes, create a more tax efficient exit. That was an interesting thing that I see more of nowadays that I got from the conference.
Right.
These new firms that are offering these new kind of services and strategies for older people that are, now kind of competing against traditional funds looking to buy properties.
Right. Yeah, it's an interesting topic. I mean, particularly with the older population. I've talked with a few different people that have approached, that is that dynamic happening as an opportunity to try to, provide services and provide benefits by, helping people get out of their houses.
Yeah.
I think it's tough though, right? Because you're either talking about an individual person who may have been in their house for a long time.
Yeah.
And they're going to sell, whether they're by themselves or as a couple, they may not have the greatest education just versus, they're just like, probably retired and not, in the mix of things as much anymore.
Yep.
And so may not be as up on trends or even how to sell houses. Maybe it's not their profession. So
yeah,
they don't know it. Well, the toughest thing when we've been presented those opportunities on a one-off house has been they're all over the place.
Yeah.
So it's kind of like, if our core buyer set, the capital that we work with to try to deploy into the market is really looking for a middle of the fairway type of thing, they were always out of it. And I'm going back to that cap rate discussion. We have to, we start with that base cap rate for a middle of the fairway. Then we have to start layering on, adjustments for risk. And by the time we got to it, we just didn't really have that competitive pricing.
Yeah.
And then you're talking about, okay, what, then there's risk of being the bad guy because it's like, look, we have to apply all this risk, but that's why our value's coming in low.
Yeah.
Then they look at it, oh, you're trying to take advantage of this old person. It's like, that's not even close to what's happening, but it's like, why don't you tell the old person to bring a house that's more well located, right?
Yeah. More central. I got that. Yeah, I know a few firms. I don't forget name of my names, but like Flock had an interesting model where like they have a big fund, so we're gonna do a 721 exchange into that. They'll manage it. They'll essentially take them out of their properties, and like they buy into their properties plus all the other properties owned in the fund. That's something a good solution.
I'm really interested with that, and I've actually put out a few different offers. With the not the exact same structure, but it had dynamics of that structure. Trying to layer in some tax benefits.
Yep.
The one thing, like the hurdle that I came across is, okay, you're dealing with somebody who probably has owned this portfolio a long time.
Yep.
And they're sitting on the cash flow. They've been a manager.
Yep.
First off, why is it that they want to sell? Because they don't want to be a manager or they don't want cash flow. Like nobody ever doesn't want the cash flow, right?
Yeah, usually they don't want to manage and they want to sell, but they don't want to pay the capital gains tax and depreciation recapture tax if there is any, but mainly capital gains tax, right? A lot of them don't do cost seg studies to accelerate depreciation, so they're not going to have any depreciation recapture, but it's just the capital gains. That's a massive amount of money that they're giving up, and they don't want to give it up when they sell, but they also don't want to manage it anymore because they're ready to retire and they just want to get rid of it.
So how much of a discount and versus of their current cash flow are they willing to take in order to achieve those benefits, right? Not having to manage and then achieve that, the
good question. It depends. It depends on, I guess they would look at the new cash flow and what they were getting before, and they would, gauge what their time and energy is worth, right? How much is alleviating that headache going to take off their plate at the end of the day?
Right.
And if their properties are managed more effectively than they could, right, and they're, and then the rents getting bumped up happens more systematically, maybe it's almost comes to a wash at the end of the day. 'Cause the new operator is going to operate it better than they ever could. So like,
like, how is it to communicate that to the seller?
Yeah,
right. Like somebody who put together,
like
I feel like that.
I was making $60,000 a month. I'm asking. Yeah, I was making $60,000 a month. Now I'm making 24. I should be happy with that. Like,
yeah, exactly. Oh yeah, hey buddy, you're going to be good because this new operator is better than you. That's going to go over well, right?
I think the pitch is, I think that the value is, you're going from a private operator to an institutional grade operator. You're going from private financing to institutional quality financing. You're going from having to worry about your houses every day to just, getting mailbox money. You have to worry about, paying capital gains tax if you sold your portfolio to not paying capital gains tax until a much later date, or doing some structuring around, what's it called, estate planning, in order to make the taxes pushed off so far that it becomes your kid's responsibility to worry about.
Yeah, there's some value in guaranteed mailbox money too. I think. I used to, spent some time being really heavily focused on 1031s, and I used to, DST was not a direct competitor, but it was a competitive product that,
Yeah.
my clients, could look at, and I always look down on it. And now that I don't have the competitive viewpoint against it now. I kind of look at all these DST offerings out there, and there's some really great offers. And if you don't get it just from the perspective of, hey, they're on the hook to, pay you this guaranteed, cash flow amount, it can be pretty attractive, and, you save on a tax bill too.
It can. Yeah. DSTs are interesting. I used to run a firm that actually sold DSTs before 2008 hit, and then 08 hit and it all went away because they couldn't get financing. That whole industry imploded. But yeah,
Right.
I don't know if there's any single family rental DSTs out there. I think there is one, but I'm not sure where to find it. I heard about one, but
Yeah, there's a few. I don't think you're going to see any scattered site ones.
Yeah.
At least I'm not aware of any scattered site, but
no front for sure.
seeing a lot of BTR deals.
Yeah.
And it's from a lot of players. So I've spent a little bit of time this year. We've talked about, I'm working on a capital raise. So I spent a fair amount of time this year at RA conferences and kind of more retail capital raise conferences.
Yeah.
And it's an entirely new world to me. Like there's all these DST, there's a lot of different DST providers, and they're starting to dip their toes into BTR.
Yeah.
And it's
Why wouldn't they?
nobody you would recognize, right?
Yeah, I'd imagine it would be all the DST firms that already do multifamily and office that are just going to be going into build for rent. It's not like that.
Exactly. Yeah, I mean, like a next point, there, I guess Beinbrook would be included in that. That's probably the one single family. I don't know if they have a DST in particular, but they're included in their diversified real estate fund. So what was your most optimistic takeaway from the conference?
Yeah, so I was there talking about our new platform, Next Level. I really wanted to get a sense of whether or not we were building something that people would use and enjoy. Basically, the way we were, I was pleased to hear the feedback. We got a lot of good feedback, and it was geared toward Next Level is basically a way for brokers to generate off-market inventory by showing people in their network buyer demand. And our theory is if owners saw buyer demand for their inventory, they would self-select and create inventory for that buyer demand. And
so is that driven from actual offers, or you're looking at what people buy, or how do you provide intelligence around that buyer demand?
yeah, so it's basically like we invite you onto the platform and you import your current portfolio, and that's it. And the system basically creates a buy box based upon your current portfolio, and you could decide whether or not to activate it or not activate it. But by virtue of coming on the platform, you're essentially building your own portfolio, so the platform knows what you own, and then you're telling the marketplace that you're a buyer for more of these kind of assets or other assets. And in my experience, sometimes all it takes with an owner is to show them the door in order to get them to actually walk through it. So if you have a portfolio of 100 properties and you were thinking about selling, and all of a sudden you could see there are 9 buyers for your portfolio, are you more willing to essentially cut off a piece or the whole portfolio and put it up for sale to those 9 buyers? And
so it's like a reality check about what's actually out there.
Yes, it's
not of Zillow or something like that.
It's not valuing your portfolio based on AVM. It's like, hey, there are 9 real buyers here for something that you built, and here's basically the price that they're willing to pay for. There's a real active market for this, and that's different than a marketplace. I feel like marketplaces make an assumption about what people might be attracted to. It uses data and it uses analytics to figure out what your assets are worth, and then you list it and you see what the offers you get. Our theory is the SFR market is such a slim and small market that even if you value your properties, the big question is, you put together this jumble of individual assets. Are there real buyers out there that want to buy everything that you built or just a portion of them? The feedback we got from buyers or owners, I should say, investors, is the concept of seeing buyer demand as an impetus to get an owner to put things up for sale to those defined buyers is a really good idea. And they like the concept of being able to come to a place where they don't just see properties that are out there on the market or get to read about buyers. They see how buyers' current demand overlaps with their current supply. And then, they get some visibility into what that buyer demand is.
So how does that, I saw a bunch of platforms had a few conversations at the conference with folks that are really doubling down more on like a pocket listing type of strategy.
Yeah.
How does your platform compare to that?
Yeah. To me, the thing about off-market listings or pocket listings, I should say, is they're not available to everyone. Meaning you're chosen. If you see a listing that's someone's pocket listing, they're choosing you to see it, and no one else is seeing it outside of you as one of the chosen few. Um, that's a really powerful thing for a broker to say to a buyer. I chose you based upon what I know about you as being the recipient of this off-market real estate that I'm looking to sell quietly on behalf of my seller. Um, we deal with that by essentially creating a mechanism where the owner can see the buyer before they ever choose to list. And then the broker on behalf of the seller can share it privately on our platform. And the buyer can actually see that they're one of the few people getting access to it. So it creates this leverage point for brokers to say, hey, you're not one of 50 or 100, you're one of 3. And by the way, you can see here that you're actually one of 3. You could see the other buyers that are getting access to it, not by name, but that they're there. That's how we're dealing with it. It's a way of us to telling the owner, by listing a property, it's not being widely marketed. It's not being exposed out there to the world. It's being exposed to targeted people that are chosen. And those people that are chosen feel special. They feel like they have an easier time. They'll have an easier time of making a deal happen because there's less competition.
And so there's potential less value loss from noise in the market, or people kind of just creating a whole bunch of hubbub that doesn't really result in bids is kind of
I feel like the benefit of listening to something on a platform, the perceived benefit is you get a lot of attention and no money is perceived to be left on the table because everyone saw it and everyone that should have bid on it. I think a lot of that value is lost by some of the most apt buyers in the market not taking a run at it because they see it on the market, quote unquote.
I
And
do
they
that
just
all
don't
the time.
pursue it, right?
I mean, I just know, again, I probably should look at things differently, and not that I just completely don't look, but I definitely have a natural affinity. Anytime I see a listing from some of the traditional commercial real estate brokers they're moving over into single family, it just I always know that, or what I think is that it's going to be listed at least 20% above what the actual value should be.
Or that it's picked over, or that you're competing against a bunch of lookers that's going to stand in the way of you actually making a deal, right? So if you take a listing by any of the big guys that it's exposed to hundreds of people versus say a small broker that brings you a deal like, hey, no one else is seeing this. I know you, Ted, and I know what you buy, and I know this might be a good fit for you. I'm just showing this to you and a handful of other people. How apt would you be to take that more seriously? Number one, you'd probably have a relationship with that broker, so you don't want to let them down. You want to keep getting off-market inventory from them.
I really appreciate it from a buyer's perspective, having scenarios like that, because when you are I completely see what the angle that you're talking about, because when I know that there's a ton of people or a whole crowd of people all rushing to around some deal, you have to view pricing differently, right? Because it's a cost. Pricing 1,000 property deal or pricing a 2,000 property deal. I don't care how much technology you have. It can't be all technology. You need to still have some, human oversight there, or else your price is going to be,
And what ends up happening in marketplaces, especially with single family, is a price is thrown out because they want to get everyone out of the mix, and they figure once everyone's out of the mix, now they can actually figure out what the portfolio is worth, and
you kind of get the same thing with a stalking horse type of scenario, right? Yeah. Maybe you have one who's coming there, and you have a second round that's limited 5 people.
I think you get the same result at the end of the day. If you showed it to 100 bidders and you got 80 bids, a lot of them are going to be bullshit bids that just aren't worth the paper they're printing. They're not real buyers. They're just throwing offers out there to see what you'll say. And then the real buyers offers you get, generally, when they feel like they have a little more time, i.e. it's under LOI, that's when they're really dig into the numbers and come up with a price that works for them. Compare that to an off-market disposition where you're actually giving each one of the buyers a little run room because they know it's not going to be swiped away by some bullshit offer that's going to be reduced anyway. You're going to get to the same result at the end of the day. It's a little less chaotic and it's a little more, I call it controlled velocity. It's you're able to give a buyer some assurance that they have a little bit of run room without it being taken away from them, so they can underwrite it more appropriately and get you an offer that really will stick all the way through contract. So
Yeah, I think that's definitely an underappreciated, factor to being.
it's a nuance, man. Yeah, it's a nuance. And I think that's why off market hasn't really been done very well on platforms. It's every time I see an off market marketplace, it's just a marketplace. It's another listing platform. And there's a nuance, to how you present deals and keeping it competitive while giving buyers the ability to underwrite without having the crowd bearing down at them at the same time. So feedback was good. I mean, I got I always get continually jazzed about feedback I hear on this thought and this product that we're building, so that people can do easier transactions within our network. So have a chat online.
Yeah, I can't wait to take a look. I definitely more intelligence, and I think not to say anything against the marketplace that are out there, but I just see more of I see more value in clearinghouse activity than I do more listing activity, right?
Yeah,
I think,
no doubt. Yep.
So
And I think that's kind of like the feedback I got from a lot of buyers and owners. They come to these conferences to meet people that have inventory they can't get their hands on unless they know the right people. And I think sellers are looking for people that are plugged in to relationships that kind of give them an out at the end of the day, so they don't have to either think it's retail or a large scale brokerage that they have to show their properties to everyone and their mother. I think they're looking for solutions to do these private transactions with people that have long-standing relationships, and that's part of what I wanted to encapsulate in Strata, not being a traditional brokerage and not being the kind of firm that has this wide-reaching marketplace platform, but is based on relationships. And I think the more the market comes down, the more important that becomes over time. Having the relationships and giving people insight into who buyers are and who sellers are at any given point. So.
No, definitely. And we've talked about it a little bit. I certainly talk about it in conversations that I have, is that I think we're in this time where there's not a one size fits all investment strategy in single family. And so you do have a lot of, smaller, more bespoke strategies where, people are getting back to the basics of being real estate professionals and figuring out their angle in the market. It's not just like a sprint or, kind of who can pay the most. There's actual opportunities for value add for people that put in the time and, kind of figure out their strategy.
Yep.
What if, aside from that, anything you heard about the big players or anybody coming back, or what's your view on market activity and, kind of how things are progressing here?
Well, the big buyers went away for my business, which is portfolio sales. By and large, they weren't picking up portfolios anymore. I saw, I won't drop any names here, but I heard of the biggest firms in the market. They'd actually hired people to kind of manage their bulk acquisition strategy. So I think bulk acquisitions might be making a return. I don't know how big or how fast and furiously they'll start up doing acquisitions, but
I kind of feel like as we were coming out of 2022, maybe it was people they didn't have conviction about putting capital into the market at that point.
Yeah.
So they might have been putting out bids. They might have intentionally been bidding themselves out of deals. Right.
Yeah. Yeah. I feel like the capital that's out there right now, that's being raised, is people like the asset class. They think it's a relatively stable one. I was happy to hear that some of the larger institutions might be starting up bulk buying again. And certainly the smaller private equity firms that have more nuanced strategies, they've raised capital and they're out there looking for their little pockets of inventory in different markets based upon their nuanced strategy. So I don't think, money's gone away or anything. I think it's all out there. It's just a matter of kind of what people are looking for via their strategy, what they're telling to their LPs. And the real key is, unfortunately, in our industry, it's finding the right fit between the right seller and the right buyer. And it's not as easy as it used to be, because it was like an ocean of money that was out there to buy these widgets. Now it's a little more nuanced of,
you have all the sellers that are still trying to sell at the old values, probably not as much as they were, and all the buyers.
Even the old values,
less buyers, right?
But calling the same buyers, with product that they might have been buying 2 years ago or 3 years ago, they're just not buying it anymore, right? And that same that same buyer, that same asset type is now being bought by a more, you know, smaller and harder to find buyer, right? Which, listen, it's actually good for strata in my business because it's our business to know who those buyers are. Back in the day, people can call a Pretium or Progress or a American Homes for Rent or an Invitation Home. They didn't need me to find them. They were pretty easy to find, but now
Right.
they're not
That's a good
as
point.
easy
Yeah.
of targets anymore. They need to actually know who to call. So
Yeah, one trend that I definitely saw over the last couple years at this conference, increasing, and I saw it even more so this time, are new builders, like traditional builders, kind of more, it's probably getting down to more, middle market, lower middle market, where they're coming to this conference to try to get into the BTR or the scattered site new construction, sale channel. And as a buyer over the last 2 years, that's been such an interesting thing to evolve. Where I think we did our first few deals because maybe out of a position of distress from the builder. It wasn't major distress, but
yeah,
it's the pace of retail sales just versus their plans slowed down dramatically.
yeah,
And so we were able to get deals done. Honestly, it was probably at their basis or maybe even, slight loss in some cases, but it was worth it for them to get the inventory off their books.
yeah.
But what we're seeing now is that I think those platforms are starting to figure out, how the value that having a churn on their capital can be, and coming to the, single family rental buyers as a way to just get, churn on their capital. And from our perspective, if it can be like a consistent channel of purchases for us, we don't necessarily need to it doesn't have to be like a big distressed buy, but if we have partners that we can count on being able to buy 5 to 10 properties a month, consistently, all of a sudden you got a pipeline. And that's been a really interesting thing for me to see.
That's the most challenging part for builders. I feel like having a consistent and reliable source of takeout capital that can buy their properties at the end. And it's kind of like a safety net. They always knew that they were there to buy their properties if they were willing to sell it at this price. That price got worse over time as interest rates went up. But like I saw the same thing. A lot of builders there are looking for institutional buyers that can buy their inventory. And a lot of those builders might have come to us in the past saying, "Hey, we showed it to these 3 institutional buyers. We don't know anymore. Can you show it to the rest of them?" And that's happening less and less because they realized that the ones that they knew weren't buyers anymore, and they needed a broker to actually find the ones that weren't as visible. So, that was something I saw a fair bit there. Builders trying to sell inventory and looking for that outlet for their properties.
100%. Yeah, I met a few new ones that, it's kind of like, it's wild. You've been in the industry for so long, been at this conference, going to this conference for over a decade, twice a year.
And making me feel old, Chad, man. I can't believe how many people I saw that I knew for more than 13 years already. I was like, looking at them. It's funny, we were talking about doing like a bunch of guys that I know that are now bald, doing a throwback video where they had big froze back in the day when the crash was just happening. We should do a spoof video on that. That'd be funny.
Definitely. Ted and Adam Unleashed on Averresi Media.